Good morning from Credo Wealth Management here in San Francisco. And it's my great honor to have our primary portfolio managers on the call with us today. We've got Greg Hahn and Adam Coons. And they're going to talk about, well, first of all, we're just going to set up and talk about what happened in the second quarter.
What happened? It's been a tough year, Courtney. What's going on in the market right now is we're seeing an adjustment in the price of risk flow through the market. So valuations on financial assets are coming down, and there's a couple reasons for that. First, we're seeing interest rates push higher. The Fed is adamant to get in front of this inflation, which we haven't seen in 40 years, a level of inflation like this. And two is the Federal Reserve has been adamant about saying we're taking money out of the system. We want to move to a neutral level of interest rates, which means short-term rates are going to go higher to help fight inflation. And the consequence of that is we're seeing both stocks and bonds, the prices fall in all assets. The stuff we're not seeing, but you wouldn't know it looking at residential housing, but it'll ultimately hit residential housing, commercial real estate, and other asset classes as well.
Yeah, that was a crazy quarter, tough conversations with clients. What do you see going forward?
So for a context, and Adam, jump in here, but from a context standpoint, we saw the S&P 500 move from a valuation that was over 20 times earnings. Historic valuations are closer to 17 times earnings. So we're seeing that adjustment. The earnings level of the S&P hasn't really changed. The challenge, though, is companies have come out and said, hey, the earnings that we had last quarter or the quarter before, don't expect those going forward. We're going to start to guide you lower. And that's part of what's happening in the earnings releases that we're seeing for second quarter.
Yeah, and I think a big piece of that, like you're speaking to, is the fact that with wages higher, costs in general have gone up. So that's the first hit to earnings. And now the second thing that we need to deal with is the fact that the U.S. dollar has actually been very strong in 2022. We just saw IBM's earnings. It's going to be about a $3 billion hit just because of currency headwinds. So there's a point where the strong dollar starts to not only hurt from a currency exchange standpoint, but also is going to mute the sales of U.S. multinationals. So I think that's another headwind to earnings coming up.
So let's see here. So, and then since you manage so many of our clients' assets in your ETF portfolios, what changes did you make or will you be making?
So we manage assets along different strategies. So there's very conservative strategies, and then there's growth strategies. So that spectrum, the changes are made in the context of what the objectives of each one of those are. But in general, what we're doing is on the equity side, we're not yet adding necessarily to the equity basis. We're shifting the equity basis to capture some of the return opportunities. For example, dividend growth strategies have actually outperformed the broad market S&P. So we have some dividend growth strategies that are in the portfolio. We also have the equal weighted S&P 500, which has performed very, very well. We have some small cap allocations. So we're changing those allocations based on changes in valuations in the market. And we're also addressing fixed income. Adam, do you want to cover the fixed income part of the portfolio allocation?
Yeah, so I think the general theme with all of our portfolios, we came into 2022 with a more defensive tilt, whether that was equities, like you said, with some low vol, but on the fixed income, we had a shorter duration tilt with the very mindset that the Fed was going to be raising interest rates. And so what we've done incrementally over the last couple months as rates have already gone up, largely trying to get ahead of the Fed. We saw the 10-year get all the way up to 347, now has gotten back below 3%. But what we did is we extended duration. We sold our TIPS position, which is an inflation adjusted fixed income fund, and that outperformed the ag. So we sold that. We increased the duration by buying long corporates, and then also sold some of our short-term corporate bond ETF to extend duration. And what that does is gives us more price appreciation ability if interest rates come down.
Okay, great. What else do you think our clients should know?
So on the fixed income side, it's important, I think, to understand that even though the Fed's pushing short-term interest rates up, it doesn't necessarily mean that long-term interest rates are going to go up as well. So we're seeing what's called a curve inversion. So short-term yields are higher than yields in the 10-year and 30-year area. We think that will be sustained during this next push higher. We expect the Fed to move 50 basis points or 75 next week or this week, 27th. Next week. Thank you.
Next week, yeah.
Yeah, and so for fixed income investors, there's an opportunity, as Adam just mentioned, to extend duration, and we're seeing wider credit spreads, higher yields. It's a great opportunity to build a fixed income portfolio that can actually throw off 4.5% in income that we haven't seen in a long time, and not take on a lot of credit risk.
And what's your viewpoint? What do you think about a recession? Are we heading into a recession? Are we in a recession already?
Adam, go ahead.
Yeah, so I mean, if we define a recession as 2 consecutive quarters of declining GDP growth, I think technically we will get a recession, and we're already in the midst of one. I think the bigger question is, how does that affect portfolios and the market as a whole? So Greg, I'll let you speak to that.
Yeah, this is the hard part. Is we're in this confluence right now where the markets are adjusting to this new paradigm. The economy's slowing, but that doesn't necessarily mean it's a bad environment to invest in. We actually think this is a great opportunity to be putting money to work incrementally into the market, both stocks and bonds. We're never going to pick the high, or we're never going to pick the low. Mm-hmm. But based on fundamentals, I mean, the underlying fundamentals of these companies are still very, very strong. And the important thing is, when we went through the financial crisis in 2008, we had problems in the financial system with our banking system undercapitalized. Our banking system right now is a strong capital position. We do not see any other issues in terms of the financial system itself that would impact investors. So really, it comes down to fundamentals. There's a great opportunity in here, both on the stock side and the bond side.
Great. Just appreciate your time today, you guys, and thanks for the update. Really appreciate it. And we love working with Winthrop. Thank you.
Thank you.